All right, guys, today we're talking AMMs, all right? Now, if I lost you, come back, don't worry. We're gonna simplify it. We're gonna make it so easy, there's no way you don't get what's going on by the end of this, all right? So watch till the end, and let's see if I'm right. An AMM is simply an automatic market maker, okay? Now, what that means is it takes two assets, sometimes more, but in this case just two, and it puts them together. It makes what's called a liquidity pool, basically just a pool where things trade back and forth between these two assets, and it allows you to always be able to transact and get the asset you want for the other asset. Let's say I have one chess piece here, all right, and $100. That's not enough. And $10,000. This is a really nice chess piece, okay? I assure you it's worth it. Now, the value of these two are equal. Okay, we're pretending the value of these two are equal. All right, so we're gonna put them in our liquidity pool here, all right? So now, if you want this $10,000, you gotta swap parts of a chess piece. Now, this metaphor is breaking down because this is not actually very divisible, whereas this is, but you just gotta roll with the metaphor, okay? So, don't fight the hypo. You're gonna swap chess pieces for stacks of cash. But the more chess pieces you put in the pool, the more it's gonna cost per dollar of cash. Because if you only have one chess piece, the algorithm's gonna say, well, that's pretty rare. I guess it's worth a stack. But if you only have, say, $100 and you have 1,000,000 chess pieces, well, now supply and demand dictates chess piece not worth very much money. Kind of like it probably should be. How this is managed is through a very, very simple formula. X times Y equals K, okay? So in our example, chess piece is X, Y is our cash, and K is the end result. So you multiply the chess piece times the cash, and that equals the end result. Now, as one of these shifts, it changes the amount you need of the other thing to multiply, because you're always supposed to have a constant of the end number, all right? So the more you buy of something, the more the other thing costs. Or conversely, the more you sell of something, the more of it there is, and so the less valuable it is over time. Now, this only matters if you're pushing enough to really change the ratios. But using this method, we're able to have liquidity at all times for assets that otherwise you'd have to have people, hey, I'm putting in a buy order for this price, I'm putting in a sell order for this price, and wait until these eventually meet and a transaction gets done. And an AMM allows you to constantly get liquidity in the assets you want, okay? But it also leads to higher price swings. Normally, when you have two people having to say, I'll buy it at that price, I'll sell it at this price, they get really, really tight in the price. And it's, we'll buy here, we'll sell here. And so there's a very narrow region in which an order can meet. And these are called the bid-ask spreads, okay? But in an AMM model, you always get to buy it for this price. This price is moving based on people's orders, though. It can go up massively or down massively pretty regularly. Now, the more money is in a liquidity pool, the less this is going to move. But it's because of this extreme volatility that you see that there's a whole bunch of other protocols that are built different versions of these pools. Take Uniswap or SushiSwap. They have in V3 a thing where you can go in there and basically say, I want to provide liquidity, but instead of providing liquidity to infinite numbers in all directions based on the prices, I want to provide it to this little range, okay? So if it's in here, use my stuff. If it's not in here, don't use my stuff, okay? And when a lot of people do that, it lets you concentrate liquidity, and now this is the range at which it's trading. Trade as much as you want, back and forth in these ranges, and if it ever slips out, well, those people stop trading. So they never accidentally sell something at a bad price or buy something at the wrong price. If they think that's the price range, that's the price range that their stuff's deployed at. Now, if they're wrong and the market's way over here and they're like, yeah, you know, I really think that USDC is going to crash again and be trading at, 80 cents. So only let me, provide a liquidity at 80 cents or so. it's not nearly as efficient as 98 cents to $1.01. On things like stable coins that are supposed to maintain a really, really tight value, this concentrated liquidity allows you to multiply up to 200 times the efficiency of your deployment of capital. So make sure whenever you're going out there and you're putting 2 stable coins in a pool, especially on Sushi or Uniswap, you make sure you concentrate it. About 99 cents and $1.01 if you're not super optimistic about them staying perfectly at it. If you are really confident, maybe 0.998 or 999 cents and $1.001 is probably the range you should provide liquidity at. That way, if it's ever so slightly above or ever so slightly below, you're still trading bop, 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 at all times, and you're getting tremendous fee income. As opposed to, well, if it ever got down to 1 cent, I'd get some fee income, but sorry, it's kind of pegged to $1. It's never going to go to 1 cent. Even something crazy like Terra Luna that blew up, still trading at 2 cents, I think. So like, concentrating your liquidity is very important. But these automated market maker models are fantastic, okay? They let you trade 24/7. So now you can make me go from a 9 to 5 day where the markets would normally close and stuff to 24/7. It's great for our mental health. It's so great. Said no one ever. But that's okay. That's okay. We have caffeine, right? We have lots of caffeine. Oh, I have so much caffeine right now. But I still get to trade on all my DEXs all the time. So it's got to be worth it, right? Now, some of you may be going, hey, this AMM model, normally there's a spread that those market makers take from me. What about in DeFi where we got this AMM model that's so much better? Well, there is a fee actually, or there usually is a fee. You see, the fee comes in what's called a transaction fee. There is a very, very small fee on most pools, okay? So small you probably won't even notice it. It's usually 0.001% or so, as long as it's something that's relatively stable. I mean, if you're swapping dog coins for stable coins or something, first off, you shouldn't be doing this, obviously. Yeah, there's going to be big slippage because there's barely any liquidity probably because people know this thing's not worth anything and this thing is worth something. This is a bad thing to provide liquidity to, okay? And honestly, it's usually best to have at least one stable asset, if not both relatively stable assets, in a liquidity pool when you're providing liquidity. Now, sometimes there might be tremendous incentives to provide liquidity to something where there's not 2 similar types of assets. And sometimes it can be worth it, but you got to be careful about doing that. All right? If you don't know what you're doing, you can suffer impermanent loss. Now, we have a whole video on impermanent loss you can go watch, but basically, it's you being affected by the prices of the assets in the pool going up or down, okay? Sometimes this can be good, almost always it's not good for you. So, something to watch out for that you wouldn't normally have in, say, your maker-taker models, where you have bid-ask spreads and stuff on an order book, okay? But, honestly, it's worth it to risk a little bit of an impermanent loss because the fees and stuff are so high. Because I hate to tell you, you guys aren't market makers. If you're day trading out there and you're going, oh, I'll buy at this. Oh, I'll sell at that. I'm sorry, you're just doing degenerate gambling. True market making is when you have a big firm and you're routing a ton of orders and you're paying for order flow. Those are the people who get the maker-taker spreads, all right? They're the people who are like, yep, bid, ask, I'm getting that spread right there, okay? As a retail user, you can't get that. You won't get that. Please don't think you're going to get that. But you know what you can get? You can get trading fees on a decentralized exchange. If you provide liquidity on SushiSwap or Uniswap, you get the fees, which is fantastic. Now, they do take a small portion for themselves, but you get a tremendous amount of it. And that can really add up, especially if it's a good like stablecoin pair and there's extra incentives. You can start cooking 20, 30, 40% on some of these things if you get the right pool. You should go check out some of the DM pools on Curve and on Uniswap and SushiSwap. Guys, let me tell you, they're crazy good. Now, they might not always be this high, but right now, for providing $1 and $1, basically risk-free, sign me up full disclosure, I have positions in all these places. I am very heavily biased. Just assume anything I talk about, I have a position in, except places like DoFinance. If you don't know about DoFinance, go watch our video on that. It might save you from something else that's coming up soon. All right, so we've talked about our AMM model. Now, why is it so important that we have an AMM model as opposed to an order book model? Yes, people get to go out there and they get to have their orders filled quicker and stuff, but honestly, most people don't have to wait too long to get their order filled anyway. So why is this so revolutionary relative to an order book method? Well, I'll tell you. Now we can automate things. We can go out there and have a protocol like, say, DD, all right? Let's say you borrow a bunch of money, okay? You borrow a ton of DD, you put up your Bitcoin, and you borrowed a bunch of DD. Well, let's say you put up your Bitcoin and you borrowed a bunch of DMUSD from the DD protocol, all right? And you got upside on your debt because you know what? Something crazy. Michael Saylor said something bad. Who knows? Whatever reason, Bitcoin fell and you're getting liquidated. Now, they actually have an extra layer of protection for liquidations, but let's ignore that for a minute. Let's assume they're selling it on the market. If they had an order book market, they would have to go and say, hey, we'll sell it at this price, and it wouldn't get filled immediately. Or they would say, oh, you have posted that you'll buy it for that. We're selling, we're selling, we're selling. And so they'd go through the order book and get a worse price, worse price, worse price. And there might not be a ton of orders in the market. Well, now you're crashing the price of Bitcoin massively and you're not even offloading all of your thing, assuming there's orders in there in the first place in the kind of volume you need. This would crash the price of Bitcoin. It would destroy a lot of things. You can't build a market based on that. Like, you just couldn't. Not safely anyway. But with an AMM model, it doesn't matter if it's 3 a.m. in the morning. Oh, you're getting liquidated? Bam. In a second. All your stuff is liquidated. They have the cash. Your debt has been fully repaid. Anybody who bid on the debt, it's taken care of. They've gotten their bonuses, all penalty. Everything is taken care of instantly. Faster than a human can ever interact with something or ever even finish filling out their order to swipe up and send. They've already executed. Everything's done. Now, it's real simple with DD, but you can do this with thousands of different kinds of protocols. So having an AMM lets you build far more complicated things that are far safer, and when things go crazy bad, let's say there's an 08 or something, we don't have to call around all of our banker buddies. Hey, you want to buy some of our bad real estate loans? No? You sure? Okay. Hey, other bank, you want to buy them? It's like they know something. But if you had something like that in crypto with AMMs, oh, it's bad, sell, bam. It's all over, done, fixed. It's as bad as it's going to get right now, and it's going better from now on. It's a much, much better system. And that's why I really like me some AMMs. Now, we'll be doing some upcoming videos soon about improvements on AMMs beyond just the limit order stuff that can really, really help improve the efficiency of these things and help do other things like bootstrap liquidity for new protocols. All right? So stay tuned, check those out, and we'll tell you how you get some juicy rewards while learning about all kinds of cool stuff. See you guys next time!